Hey, this is Brant from Wolf on Wall Street Trade. It is Sunday, December 19th, 2018. I have a year-to-date chart of the SPY and a couple things I want to go over quick, just kind of where we have been. First, we have this huge volatile trading range, and when you get price, chopping around in this huge kind of range, traders see a lot of things, kind of like looking up at the clouds and seeing a picture in the clouds. And I just want to walk back a few things that they've been looking at. I'm going to pull up volume as well here. There we go, and zoom in a little bit and walk this chart back. So one of the first things that traders were seeing was a potential inverse head and shoulders. So this would be the left shoulder, this would be the head, this would be the right shoulder. Now, a head and shoulders pattern, first of all, volume confirmation is crucial. For an inverse head and shoulders pattern, it's even more crucial. So what I was pointing out at the time was volume was completely wrong for this kind of pattern, and what you want to see is volume on the declines like this, pulling back or lightening up. Instead, it was advancing, as you can see here, and you want to see volume on the rallies advancing, and that's not what was happening. It was declining. So this was not a great candidate for an inverse head and shoulders. And if we walk through and see what happened next, prices came down kind of to the bottom of this range around 263 for the SPY, and now traders looking at this and saying, oh well, look at that, it's a double bottom staring up the clouds again. And for whatever reason they keep wanting to see a bull. I kind of see a bear when I look at this, but it looks similar to the way the market bottomed earlier this year, right here, kind of a double bottom. Or if you go back to 2015, 2016, that's how the market bottomed, with like a double bottom kind of thing. Look at the volume here too. So let's move forward again. And this is how we kind of came off that bottom real tentatively in something like a little flag, and then Powell came up Wednesday and the market spiked higher. So I can get rid of volume at this point. And we moved into the end of the week, which was the G20, going into that G20 weekend. And the market opened higher. So that's how the market opened. Let me switch to the S&P 500. It was a doji star. This is Monday. And what was interesting about this was how bond yields were acting. When you get this big choppy range, like I was saying, you could see a lot of different things. And so you kind of have to look for evidence elsewhere. And one of the things I saw on Sunday night was futures were up about 2%. And the 10-year yield was up about 6 basis points. I'm estimating that because it was futures at that point. But it was up about 6 basis points. That made sense. Everything, okay, we got a rally off the G20, that tariffs aren't going to be increased as of January 1st. There'll be a 90-day wait period on that, and they're going to negotiate. So, fine. Monday morning, before the cash open, all of a sudden the 10-year yield is only up 2 basis points. That struck me as strange. And then we go into the cash open, and it continues to fall. So this is actually what I wrote for members at 10:45 on Monday morning. What is a little surprising and stands out the most this morning is bonds. Bond yields are moving in the wrong direction for stock market bulls. The 10-year yield was about 6 basis points higher Sunday night, reflecting a more risk-on tone and rotation out of bonds to stocks. But the 10-year yield came down only plus 2 basis points this morning before the open. Now it's flat and near the lows of the day. And the yield curve was also flattening as well. Treasury yields look surprisingly risk-off, not even on a relative basis versus the S&P, just outright risk-off. And here's what happened next. On Tuesday, big day down. Wednesday, the market was closed in honor of President Bush's passing. And Thursday, we got this rally off the lows off of the SPY 263 area. Almost looked like a little bit of a hammer. And I'll show you what was not right about this day. And then Friday, not even a big impulsive move lower, just a persistent grind lower here on Friday. And if we look at a weekly chart of the S&P 500, it is ugly. Here's the weekly chart. Here's the weekly candle. This is the open on Monday. This is the close on Friday. That is a huge bearish engulfing candle, or in Western vernacular what would be known as an outside week. Engulfed the previous week, opened up here, closed down here near the lows. Very, very ugly, very bearish, but it's still in this range for the SPY, or the S&P. If we look at a few of the other averages and what's going on there, you start to get more of a flavor for what's going on in the market. So here's the NASDAQ 100, and I'm going to go back to a daily chart. And what I want to point out is that if you look at the NASDAQ 100, what is it doing here? It's making lower highs, lower lows. So what do I mean by that? I'll just kind of draw up here. We have a lower high. Oh, sorry. Lower low, lower high, lower low, lower high, lower low, lower high. So that is the definition of a downtrend. If we drew, some trend lines, basically this is what you would have if you connected those lower highs, lower lows. That is a downtrend. The S&P is a little more lateral, but if we go and look at the Russell 2000 or the IWM and draw in some trend lines, just roughly here, this is what we get: a descending triangle, or descending consolidation, because it did not make a equal or a higher high on this rally. This is a bearish price pattern, and it actually broke down below that on the close on Friday. Okay, I want to touch on two other things before I wrap this video up. In the top window I have the S&P 500. In the bottom window I have the count of 52-week lows for the NYSE Composite Index. And one of the things you hear in financial media a lot is that the sell-off from October here is just a healthy correction, or presumably maybe a test of the low. So we haven't even gotten to the S&P 500's low of the year. We haven't tested that yet. But look what's happened with this selling pressure. The count of 52-week lows has exploded higher, well above what it was earlier this year. That's not a healthy test or healthy correction. That's not how a market bottoms. And if we look more specifically at what happened this last week, let me zoom in here a little bit. I'm going to walk the chart back. So this is Monday, the open, and here's Tuesday. The market came down, and these 52-week lows moved up. Then Wednesday, the market was closed, and Thursday, the market gapped down, rallied off the low, and closed with something like a bullish hammer. So that would be about the 263 level for the SPY. So it looked kind of like a constructive test of that low and rallied off. But if you look at the 52-week lows for the NYSE Composite Index, they exploded higher again, above what they were here in October. That is not what you want to see on a constructive test. You want to see that actually decline. And here's where we ended on Friday. So I want to show you this kind of analog I've been talking about, that the market looks similar to 2007, and I'll show you what new lows did there. Here's a daily chart of the S&P 500. It is rolled back to about October of 2007, the record high. So you can see the bull market here. A lot of similarities, in my opinion, to where we are in 2018, but that's not the point of this. And let me just zoom in a little bit. Some of the similarities are a record new high in May over here. The market sold off sharply and then rallied to another new record high in October, less than 3% above the previous record high. Most importantly, important sectors in the S&P were not participating. In both cases, financials. But again, I'm not trying to say, look, this is an analog or roadmap for where we are now. I want to point out what was going on in market breadth. So let me pull that up. And this is the same thing we were just looking at. The count of 52-week lows down here in the lower window. So that first sell-off, you can see the 52-week lows expanded. And let's see what happens as price comes down for a second time. And there it is. And we basically come back, let me zoom in, and test this kind of 1406 area for the S&P, right around there. And like now, what you can see is that the count of 52-week lows is actually expanding rather than contracting. So it's very similar in that way too. From a price perspective, it looks like, well, you know, it's finding support at 1406 or thereabouts. But when you add in the market breadth, you get a different picture. You can see that the selling pressure hasn't abated, it's actually increased. And I'll just show you what happened next. Another leg lower. And we're back to daily chart of the SPY, and what I think was probably one of the most important things that happened this past week, was what happened in fixed income. So I'm going to add the 10-year yield, and the scaling is going to get a little bit wacky here, but I want to just be able to show you. So here's the SPY, here's the 10-year yield in white, and what we were seeing towards the end of 2017, the market's rallying, yields are rallying, but yields were spiking to a new cycle high. This is kind of like an earthquake in fixed income, and everything gets repriced. So there's the initial sell-off in February, and then again October 3rd, which is right here, yields spiked to a new high. The market completely ignored it on October 3rd, and then October 4th it did not ignore it any longer and sold off. So that's what happened, and I'm going to go to a 60-minute chart just to show you what happened this past week. So here is the October low for the S&P, and you can see yields, or the 10-year yield, starts to make higher lows here, and it leads the S&P higher. Over here you can see it's leading lower. Credit was collapsing here, the market moves lower. And this is into the week where Powell came out and sounded a little bit more dovish, and yields moved down a little bit, and that's to be expected. You know, he came out a little bit more dovish. And here is last Monday, after the G20 truce, or whatever you want to call it, and what I was talking about earlier in this video, where yields just started collapsing and leading lower. In my opinion, this is another fixed income earthquake, similar to October 3rd, but yields are sharply leading lower, and you can see the market has so far followed that lower. And relative to where we were over here, they're leading sharply lower. So that's kind of my premise, is that this was an earthquake in fixed income, and the market had to reprice. That was almost 20 basis points, this move here. This is about 16 basis points lower last week. They're reflecting two different things. One was a much more hawkish Fed than the market had been pricing in all year. This is growth and inflation being marked down, and sharply. So the yield curve inverted, or some of the yield curves inverted. The 2 and 10 moved close to inverting, and people get upset about that, and they start screaming about the yield curve, and bond traders call stock guys, you know, macro tourists, and that's not even the point I'm getting at. The point I'm getting at is that what the yield curve tells us about this move is that growth and inflation are being marked down. So again, relative to the S&P, leading sharply lower going into next week. And in my opinion, that's probably one of the most important things. A earthquake in fixed income, and all risk assets will reprice, in my opinion. So that's what we're looking at going into next week. Hope you enjoyed the video.